Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at EON Resources.
If you find our talks useful, please consider subscribe, like, and comment underneath. So let's just set the stage here. Picture this. You're sitting at your desk. It's mid-March 2026.
Right, just a standard morning.
Yeah, you're sipping your coffee. You pull up your market momentum scanners just to see, where the institutional money is flowing today.
Always a good idea to check the scanners.
Exactly. And suddenly, lighting up the board, sitting right there on the top movers and unusual volume lists, is this tiny microcap energy company called EON Resources.
Which is pretty wild when you look at their size.
It really is. I mean, we are talking about a company with a market cap of roughly $20 million. In the grand ecosystem of the stock market, $20 million is basically a speck of dust.
Oh, absolutely. It's tiny.
But yet it's suddenly experiencing this massive influx of trading volume. It's acting like a total magnet for serious capital. So our mission today is to figure out the actual mechanics behind this move.
Yeah, we need to see what's under the hood.
Right. We want to understand if their massive physical footprint down in the Permian Basin makes this like a hidden gem for a 3 to 6 month swing trade, or, if this momentum is just a temporary flash in the pan.
Well, the sheer scale of the physical assets backing up that tiny $20 million valuation is honestly the perfect place to start.
Okay, lay it out for us.
Because before we even look at the recent price action or the algos or the trading volume, we really have to understand the ground they physically control. I mean, in the energy sector, fundamental valuation always begins in the dirt.
Right. It's all about the real estate.
Exactly. And EON operates approximately 20,000 contiguous acres entirely within the Permian Basin.
We should probably pause on that for a second because, the Permian Basin isn't just some random patch of dirt.
Far from it, yeah.
Spanning across West Texas and southeastern New Mexico, it's essentially the crown jewel of American energy production. Geologically, it's famous for having stacked pay zones.
Right, which means multiple layers of oil-bearing rock.
Yeah, stacked on top of each other like a massive underground layer cake. So sitting on 20,000 acres in that specific region is a massive structural advantage. And EON is specifically focused on the Grayburg-Jackson and South Justis fields over in New Mexico, right?
Yeah, they are. And that geographic concentration is vital, especially that word you used earlier, contiguous.
Contiguous, right. Meaning it's all connected.
Exactly. Their land is all physically connected. They aren't driving heavy maintenance trucks and laying expensive pipelines across 3 different counties just to service scattered, isolated plots.
Which would be a logistical nightmare.
Totally. So that geographic density creates immense operational efficiency. Across that tightly connected footprint, they actually currently boast 750 producing and injection wells.
Wow, 750. That's a lot for a microcap.
It is, and those combined wells are yielding over 1,000 barrels of oil per day, which, if you look at their fiscal year, translated to $20.27 million in top-line revenue.
Okay, wait. Over 1,000 barrels a day for a company valued at roughly the same amount as their annual revenue. That's wild. But looking at their operations, they aren't out there wildcatting, right?
No, they're not taking those massive exploration risks.
Right. They aren't drilling massive new horizontal gushers and just hoping to strike black gold. They're heavily utilizing a technique called waterflood secondary recovery, which I imagine is essentially the process of sweeping up what the initial drillers left behind decades ago.
Yeah, that is the core mechanism of their entire business model. Let's actually look at the natural life cycle of an oil well for a second.
Sure.
During the primary recovery phase, when a well is first drilled, the immense natural underground pressure of the earth pushes the oil to the surface. It's that classic image we all have of oil extraction.
Big geysers shooting up.
Exactly. But eventually that natural geological pressure just depletes. The well might have only given up maybe 15 to 20% of the oil physically trapped in that specific rock formation before it simply stops flowing on its own.
Meaning there's potentially, 80% of the oil still sitting down there?
Yep. Just trapped in the microscopic pores of the rock without the pressure to push it out into the pipe.
Okay, which brings us to the mechanics of secondary recovery.
Right. So to get that trapped oil, you take treated water and you inject it at incredibly high pressure into specific dedicated injection wells that surround your main producing well.
Okay, got it.
That pressurized water acts as a sweeping mechanism. It physically forces its way through the microscopic pores in the reservoir rock, pushing the remaining trapped oil ahead of it toward the main production wellbore.
Okay, let me try to visualize this for everyone listening. Is this basically like taking a sponge that someone else already squeezed for the easy water, but now you're applying a heavy-duty industrial press to force out the remaining drops at a low, predictable cost?
That is literally the perfect analogy. You are applying the heavy-duty press to the sponge. And because they hold a 100% working interest across these fields, they have a massive operational edge.
Wait, 100% working interest, meaning they don't have to share the decision-making?
Exactly. Because they hold that interest, they don't have to ask 5 different roommates for permission to squeeze the sponge. In oil and gas, a working interest means you bear all the operational costs, sure, but you also reap the absolute full share of the production.
Oh, that makes sense. So no red tape.
Right. They don't have to consult with a dozen different fragmented leaseholders to make a simple operational decision. If they want to treat the water differently or adjust the injection pressure across the South Justis field, they just execute the plan.
That absolute control has to be a massive scale advantage over smaller competitors, right? The ones
Oh.
who share overlapping leases and get bogged down in boardroom arguments over who pays for a new pump.
Exactly. It's a huge advantage. They control their own destiny.
Okay, so they own the sponge, they have the industrial press, and they are squeezing out 1,000 barrels a day. But I'm looking at their balance sheet, and I really have to play devil's advocate here because the numbers feel completely paradoxical.
I had a feeling we'd get to the balance sheet.
Well, yeah, if they are generating over $20 million in annual revenue, why in the world is their net income sitting at a negative $9.08 million?
It's a big number, I know.
It's huge. Their trailing 12-month earnings per share is deeply negative. They're losing almost half the market cap every single year. I mean, if I ran a local pizza shop with those margins, I'd be bankrupt by Tuesday. Wall Street usually runs screaming from numbers like that.
You've hit on the classic balance sheet paradox of a company operating in a highly capital-intensive transition phase. That negative $9 million net income looks absolutely terrifying on the surface.
Yeah, it really does.
But it's heavily skewed by post-rebrand, startup costs, and incredibly aggressive recent acquisitions. The biggest capital sinkhole on their books right now is the integration of the South Justis field.
Right, that's the acquisition they closed back in June 2025. They bought 130 producing wells. Let me deduce the problem here. When you buy 130 older wells meant for water flooding, they don't exactly hand you the keys to a pristine turnkey operation, do they?
Oh, far from it. Acquiring a legacy asset like South Justis requires massive upfront capital expenditure. You are taking over infrastructure that may have been severely neglected by the previous operator.
So things are broken down.
Constantly. You have to physically dig up and replace miles of rusted or corroded water injection lines. You have to upgrade the local electrical grids, power the sites, optimize the surface pumps, and treat the underground wellbores for severe mineral scale buildup.
Okay, so they're basically rebuilding the car while driving it.
Pretty much. EON is intentionally favoring aggressive reinvestment into the business over showing a pretty quarterly profit. They are laying the groundwork for future horizontal drilling expansion by pouring every dollar they generate right back into the New Mexico dirt.
I understand the theory behind aggressive reinvestment. You spend heavy capital now to build a cash machine for tomorrow, but a negative $9 million hole is massive for a company this small. As an investor sitting at home, how do you know management is planting seeds for future growth rather than just, setting a pile of cash on fire?
It's a very fair question.
Because they could just be terrible at integrating these 130 wells.
True. When raw financial metrics are muddied by heavy acquisition costs like this, you have to look for alternative signals of corporate health. And the strongest, most undeniable signal you can find in the public markets is what the insiders are doing with their own personal bank accounts.
Ah, right. We're talking about following the money of the executives and the board of directors.
Exactly.
Because if they are aggressively buying the stock themselves, that tells a vastly different story than if they are dumping their shares to the public.
And we actually saw a massive shift in executive behavior right after the company's recent 10Q blackout period lifted.
Okay, for context for anyone listening, a blackout period is that strict regulatory window around a quarterly earnings report where executives are legally forbidden from trading their own stock, right? Just ensuring they can't front-run public information.
That's right. And once that legal window closed, we saw a flurry of mandatory SEC filings. Specifically, Schedule 13D amendments and Form 4s.
Right. The public documents insiders legally have to file when they buy or sell their own company's stock.
Yeah. And these filings showed heavy, aggressive accumulation.
Hmm.
We aren't just talking about a token 100-share purchase to look good for a press release. They're putting serious personal wealth on the line right when the integration costs of South Justis are at their absolute highest.
Wow. So management and major stakeholders were actively buying up shares on the open market?
At least they were.
And let's be real here. Executives might sell their stock to buy a boat, pay taxes, or fund a divorce, but they only buy on the open market for one singular reason. They believe the stock is undervalued and the price is going up.
Exactly. That open market accumulation is a neon sign to the market. It indicates that management firmly believes in the long-term cash flow generation of those 750 wells.
They see the daily flow rates?
Right. They know the actual ground-level water flood efficiency.
Mm.
Their personal capital is telling the public that the negative $9 million is a temporary necessary integration cost, not a systemic operational failure.
Okay, so that explains the foundational value and the insider confidence, but it still doesn't explain the timing for me.
The timing of the volume spike.
Yeah. Why did this tiny stock suddenly light up the momentum scanners between March 9th and March 12th? The trading volume went through the roof and the stock was gapping up, meaning there were so many overnight buy orders that the stock opened the next morning significantly higher than it closed the previous day.
Yeah, that was a huge move.
Institutional momentum flow clearly found EON Resources. What was the specific spark?
The spark was a massive macroeconomic shockwave. Around March 12th, the broader market was digesting a severe flare-up in Middle East tensions, specifically focused on geopolitical risks surrounding the Strait of Hormuz.
Okay, so looking at this strictly through the lens of economic impact and supply chains, ignoring the complex politics entirely, the Strait of Hormuz is essentially the global economy's jugular vein.
It really is.
It's one of the world's most critical maritime choke points for crude oil supply. If shipping is threatened there, the global supply chain panics.
And that panic creates highly predictable market mechanics. Anytime there's a perceived physical threat to global oil flow, institutional capital reacts violently and defensively. Quantitative funds and massive portfolio managers immediately sell out of riskier, high-multiple sectors like consumer tech.
And they dump it into energy.
Exactly. They take that cash and flood it into safe domestic energy producers. It is a massive flight to safety. And because EON Resources has 1,000 barrels a day of domestic, completely physically secure Permian Basin production, it becomes a structural magnet for that rotating institutional capital.
Oh, I see. It is the ultimate safety of domestic dirt. They don't have to worry about oil tankers being rerouted across the ocean.
Precisely. They're immune to that specific supply chain threat.
But wait, there was another specific catalyst right in the middle of that macro panic. On March 11th, EON announced it expanded its oil hedging for 2026 and 2027.
They did, yeah.
Wait a minute. If global tensions are driving the price of oil through the roof, doesn't hedging limit their profits? I mean, why would management cap their upside right when the commodity they pull out of the ground is surging in value?
It seems entirely counterintuitive at first glance, I know.
Yeah.
Your natural instinct is to ride that price wave as high as it will go to maximize revenue. But for a $20 million microcap burdened with heavy integration costs, expanding those financial hedges is incredibly prudent.
Okay, break that down for me.
Hedging involves entering into financial contracts that lock in a specific, guaranteed selling price for your future oil production. And that's regardless of what the open market actually does over the next 2 years.
So it is essentially a massive multi-year insurance policy.
A vital one. Consider the alternative scenario here. What if the geopolitical tensions in the Middle East suddenly de-escalate tomorrow? The fear premium evaporates and global oil prices plummet back to earth.
Right, the bubble bursts.
Yeah. A massive conglomerate like Chevron can absorb a temporary price crash. A $20 million company relying on every single dollar to fix rusted water lines in the South Justis field. They could be entirely wiped out by a sudden drop in revenue.
That makes a lot of sense.
By locking in their 2026 and 2027 base revenue right when prices are artificially high, EON guarantees their survival. They know exactly how much cash is coming in to cover their fixed electricity costs, their maintenance, and their ongoing operations.
They are trading the wild lottery ticket of a massive oil spike for a guaranteed paycheck. And given that they desperately need that guaranteed cash to finish integrating their new acquisitions, it is actually a brilliant strategic move to protect the baseline business.
Exactly. It ensures that regardless of global macro volatility, They have the runway to execute their business plan.
But even brilliant strategic moves don't eliminate all the danger, right? Every bullish swing trade thesis needs a rigorous stress test. The 2026 hedges protect them from an absolute oil price crash. But what other threats are lurking? Like, what is the bear case that could sink this company?
The bear case is substantial, and it really hinges on two critical factors. First, even with those protective hedges, commodity volatility is a relentless threat. Hedging contracts rarely cover 100% of a company's total output.
Right, there's always some exposure.
Exactly. And more importantly, Wall Street sentiment is notoriously fickle. The valuation multiples that large funds are willing to assign to an energy company fluctuate wildly based on the underlying price of crude.
So the stock price could tank even if the company is fine.
Yes, if oil drops dramatically, the stock's momentum and overall valuation will suffer, regardless of how well hedged the base production actually is.
The rising tide lifts all boats, but a receding tide grounds them all. If oil tanks, the sector tanks, and EON goes down with it. What is the second major risk?
The second, and arguably much larger threat, is purely operational execution. We talked about that -9 million net income and the heavy ongoing integration of the South Justis acquisition.
Right, fixing all those rusted pipes.
Yeah. Taking over a legacy asset and turning it around requires proving you can actually achieve new efficiencies in those waterflood operations. The math only works if the heavy-duty industrial press you mentioned actually squeezes out enough new oil to cover the massive electricity and maintenance costs required to run the surface pumps.
Let me connect the dots here. So the clock is ticking loudly. They bought the massive assets, they have the 750 wells, and they secured the hedges to buy themselves some financial runway. But now they actually have to execute.
All right.
If they can't physically get those water floods working efficiently in the South Justis field, those financial hedges are worthless because they won't have the physical barrels of oil to sell. The ongoing capital expenditures will just sink them.
Execution risk is the silent killer of microcap companies. It is relatively easy to buy the acreage and outline a grand turnaround strategy in a boardroom. It's an entirely different beast to profitably pull the resource out of the rock day after day.
It's all about the actual grind.
Right. Management's confidence is a great indicator, but eventually, the quarterly spreadsheet has to show that the asset can yield a consistent profit. They have to prove the turnaround works.
Oh, okay, let's synthesize the risk and reward here. We have the underlying assets, the 20,000-acre contiguous moat in the Permian. We have the macro tailwinds from the global capital rotation into domestic energy. We have the aggressive insider buying and the protective 2026 hedges. And of course, we have the very real operational execution risks regarding the South Justis integration. Based on all of that, what is the actionable thesis for someone looking at this setup?
Structurally, the analysis gives this setup a bullish score of 7 out of 10.
7 out of 10.
And the recommended target horizon is not a, buy and forget about it for a decade kind of strategy. It is a targeted swing trade into their Q1 2026 earnings, giving us a focused 3 to 6 month window.
So it is a play on the current momentum and the upcoming integration updates. Give me the summary for why that specific 3 to 6 month window is the sweet spot.
Well, EON Resources operates as a highly leveraged upside play within the current macro energy rotation. At a $20 million valuation, the broader market is currently undervaluing a company that reliably produces over 1,000 barrels of domestic oil daily.
Especially when you factor in the financial safety net of those hedges.
Exactly. But the real reason for that specific time window is a massive looming wildcard.
Oh, we love a wild card. What is the hidden catalyst?
It is an unconfirmed speculative upside regarding their horizontal drilling rights. Currently, EON's operations are almost entirely focused on vertical water flooding in the San Andreas Formation. But beneath that, there is immense geological potential for horizontal drilling.
Oh, wow. Okay, so what's the holdup?
The problem: horizontal drilling is astronomically expensive. Drilling 2-mile lateral wells requires massive upfront capital. So the speculation building in the market is that EON might farm out those horizontal rights to a new, deeper-pocketed partner.
Okay, let me make sure I'm translating farm out correctly. Did that mean EON basically goes to a massive driller like Chevron or Pioneer and says, look, we own the rights to drill horizontally on these 20,000 acres, but we don't want to spend the capital to dig the laterals.
Right.
You pay the massive upfront costs for the drilling, and we'll just take a royalty cut of whatever oil you manage to find.
You've captured the exact mechanics. A farm-out agreement allows EON to monetize the deep, long-term upside of their Permian acreage without taking on the massive financial risk of drilling complex horizontal wells themselves.
That's genius.
It is. If news breaks within this 3 to 6 month window that they have successfully secured a farm-out partner, that acts as an explosive, zero-cost catalyst for the stock price.
Wow. So you have this steady, reliable baseline of the vertical waterflood operations, protected by the multi-year insurance of the 2026 hedges. And sitting right on top of that, you have the lottery ticket upside of a potential horizontal farm-out partner, all trading at roughly a 1-to-1 revenue multiple.
That unique combination of structural downside protection and massive speculative upside is exactly what creates that 7 out of 10 bullish setup.
I love how all these mechanical layers connect to create the bigger picture, which leaves us with one final thought to ponder here. We started this discussion looking at a tiny $20 million microcap energy company suddenly lighting up the market scanners.
Right, just a blip on the radar initially.
Yeah, but if a company this small is sophisticated enough to successfully lock in complex 2026 and 2027 oil hedges, and it is attracting massive open market insider buying from the executives who know the dirt best, what does that say about the broader institutional belief in a prolonged energy supercycle?
It's a fascinating question.
It really is. Like, is the real hidden value here the 1,000 barrels of oil we already know about flowing from the pumps today? Or is it simply having absolute 100% working control of 20,000 acres of prime real estate in the Permian Basin, right as global tensions make domestic energy the most valuable commodity on Earth?
That's the billion-dollar question.
That is the question you have to ask yourself when looking at this space. Keep looking for that deep fundamental value where others only see surface volatility. Thanks for joining us on this talk, and we'll see you next time.